Now you can really see a gap there. We are way beyond the 2011 high at this point, and the tiny gap that's left is just a few pennies. And we have basically at this point completed the 45-year cup and handle that is predicting triple-digit silver, and I think it's going to be mid-triple digits. It's good that they try to manipulate silver. You have been able to buy silver at much lower prices than it should have been for a long time now. And now they are going to pay the price because of the price suppression is what causes mining of new metals.
Silver just did something it hasn't managed in 45 years. It closed above its 1980 record. Mike Maloney from goldsilver.com says the London close hit $49.68, officially surpassing that legendary mark. The only thing left now is the intraday record from the Chicago Board of Trade, which peaked around $52.80. That level still stands, but for Maloney, the significance of this new close can't be overstated. Here's the setup. Over the past 2 weeks, silver's candles showed steady, confident gains. Then came a sharp reversal, a shooting star candle with a long upper wick and a close below the open. That's typically a bearish signal, often suggesting exhaustion after a strong move up. But this time, the close was still higher than the previous days, meaning the broader uptrend remained intact. Some traders immediately cried manipulation when the drop hit, but Maloney thinks it was more mechanical than sinister. The sudden slide likely came from a margin hike, a change in trading requirements that forces some leveraged traders to sell. The bigger picture, though, looks explosive. Silver has already smashed through every major resistance level from 2011 and is just ticks away from overtaking its all-time intraday high. Maloney says the massive cup and handle formation that's been developing since 1980, a structure 4 decades in the making, now appears complete. If that pattern unfolds the way technical analysts expect, it could signal the start of silver's most powerful run yet, potentially driving prices into triple digits as the next major bull phase takes hold. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I made this chart. It looks a little funny. Why? Because when you go back all the way to January 18th, 1980, stock charts does not have intraday pricing. All they have is the close. That's the data that they've got. So the open is 49.45, the high was 49.45, the low was 49.45, and the close was 49.45. And so it's just a single line. But what I wanted to show you, this was the previous high so this is the close that people refer to back in 1980. That is the high. So from Peter Spina, silver closes at historic highs in London. Highest price close in history. Exceeds January 1980's prior record close of 49.45, and it closed at 49.68 rounded. Silver set to break intraday record highs from January 18, 1980, Chicago Board of Trade, $52.80. And so I made this chart just a little while ago. This goes back to Monday before last. And when you're looking at these candles, for anybody that doesn't know how to read them, the fat part, when it's a hollow body candle like this, the fat part at the bottom is the open, and then the intraday price action as things are going up and down is the wicks that might stick out of both ends, maybe not like this candle. And then the close is up at the top of the fat portion of the body. A black candle, this was the open, the intraday, and then the close is at the bottom. So Monday, Tuesday, Wednesday, Thursday, Friday, Monday, Tuesday, Wednesday, Thursday, boom! And then something happened, something changed, and the price fell dramatically and closed below its open. However, the close was still above the previous day's close. So based on a closing basis, this is still continued an uptrend. But this is, I think it's called a shooting star. It's a bad omen. It's technically it's supposed to not be a good sign. However, since it closed above its previous close, it's still an uptrend. And it doesn't matter. And when everybody looks at this, they scream manipulation. It's got to be manipulation. Well, In this case, it was, and I think I've got some evidence here. I think what happened. So, Bob Coleman, CME margin increase alert. COMEX increases margin requirement for gold 5.8% and silver 9.3%. So, what I believe happened is it opened and it just started, it may have fallen a little and then starts taking off like a rocket. And right about there, they announced the change in margin requirements. What does that do to all the people that are holding futures, which is where the spot price is derived by the paper market? And so all these people that are gambling on the commodities exchange, they've got these highly leveraged positions, and then they get a margin requirement, which is basically a margin call. They either have to cough up that cash or sell part of their position. And so it causes selling pressure. So if they announce it there, people were selling and selling and selling, and then the market closed there. And that avoids forced liquidation. Tomorrow, if they haven't coughed up the cash or sold part of their position, the brokerage house will do it for them and keep whatever they need to keep. But it doesn't matter. This is the 45-year cup and handle that I was the first one to identify. Everybody, including me, we were all focused on this cup and handle that had happened from 2012 until 2024. And then, I said when it breaks this resistance line here, we're going to have a slingshot move. And boy, has it been a slingshot from $25 to $49. It's huge. But what I wanted to show you is I tried my best. You can only move that blue line by 1 pixel at a time with the up and down arrows. And so I tried my best to get this on 49.45. 49.32 is as close as I could get it. The overlap, it doesn't really overlap because this line stopped at the pixel below this line. Anyway, it shows that there's a little gap there, and it looks like it's touching there.
Mike Maloney says the silver market is showing signs of a developing short squeeze. Reports out of London indicate that physical silver is nearly impossible to lease, with short-term lease rates exploding to 20 to 30% if you can even find a lender. That's not normal market behavior, it's a sign of severe tightness in supply. In fact, silver lease rates have now climbed above platinum, suggesting the shortage isn't just regional, it's global. According to Maloney, there's still silver in the system, but much of it isn't in a usable form. It's tied up in industrial processes, unrefined stockpiles, or products that can't be quickly converted into deliverable metal. That's where the squeeze comes in. Physical demand keeps rising, but refined supply can't respond fast enough. The longer this mismatch continues, the greater the pressure pushing prices higher. Some in the silver community believe the ongoing attempts to suppress prices are deliberate, an effort to hide how tight the market really is. But Maloney points out the irony. Years of keeping prices artificially low discouraged investment in mining and refining capacity. Now that real-world demand is surging, that neglect is catching up, leaving the market dangerously short on physical silver. Let's get back to the interview.
Hearing short squeeze in silver. Seems nobody's got silver in London, and lease rates skyrocketed 20 to 30% for short term if you're lucky enough to find a lender. Silver squeeze is on. Silver lease rates now much higher than that of platinum. So there is definitely a squeeze, and it is global. This is Eric Young again. Robert Gottlieb, quote, over-the-counter silver going to ETFs and India demand, basically no free-floating silver left. And Eric says, this is the first time ever I read Gottlieb write that there is basically no free-floating silver left. Robert Gottlieb is an ex-executive of J.P. Morgan Bullion Bank. This is the largest gold trader in the world, I believe. This is the J.P. Morgan Bullion Vault is right across the street from the Federal Reserve. There's these theories that there's a tunnel between them and stuff. It's on same number of stories below ground level. There's a reason for that. That's where you run into bedrock. But Dana Samuelson, friend of mine, great guy. Robert, Why are lease rates sky high while refineries are backed up 4 weeks due to oversubmissions? It seems that there's a lot of physical, or is it just not enough 1,000-ounce bars to meet demand? And that's when Robert responded, OTC silver is going to ETFs in India demand. Basically, no free-floating silver left. Now, the free float is the stuff that's in the vaults, like at the London Bullion Exchange, or the stuff that's available for delivery. It's all gone. That's what he's saying. But what I want to point out here is inside Dana's question is something very interesting. He says the refineries are backed up 4 weeks due to oversubmissions. So there's lots of mine supply coming to market, doré bars, which are impure, to the refineries, but the refineries are now the choke point. They can't process any more silver, so they can't meet any more demand than this. And that means that as long as there's more physical demand, that this is more upwards price pressure. If they can't refine silver at a rate that fills the demand, the price has to go up. So this is actually very good if you're a silver investor, that the refineries are backed up 4 weeks. So it isn't that there's lots of physical silver. There may be lots of physical doré bars of impure silver that can't be sold on the retail market, but to get them through a refinery, pour it into 1,000-ounce bars, which are the source. You melt those to make coins and 10-ounce and 1-ounce bars and all the other things out of silver. And the refineries also make 100-ounce bars. They can't, all of that silver, all of the products that retail is buying is limited by this choke point. Moving on. So Hansa Czerny says, huge drop in London silver free float and a perfectly timed paper dump. So this was on October 7th. That was a day that silver fell. LBMA just released their September data, and the numbers are interesting. And so this meme, when 888 tons disappear and you still have to pretend it's fine. What did they do? They hit the dump paper price. So none of this matters. It doesn't matter. In fact, it's good that they try to manipulate silver. You have been able to buy silver at much lower prices than it should have been for a long, long time now. And now they are going to pay the price because of the price suppression is what causes mining of new metals. Less material comes to market because the price isn't high enough. And that causes the shortages, which we are now seeing the benefit of. Why are they losing control? Because the paper market no longer has anything to do with it. Tim Richardson says Martin Place, which is in Sydney, Australia, Q is ballooning now. Gold rush, this is 11:20 a.m. And yes, this is the great gold and silver rush of the 21st century.
Something remarkable is unfolding in the silver market, and it's no longer just about charts or technical setups, it's about scarcity colliding with belief. What we're seeing isn't a speculative spike, it's a slow revelation that real tangible silver is far rarer than the price ever suggested. After decades of being treated as a forgotten metal, silver is suddenly reclaiming relevance, breaking historical barriers that once seemed untouchable. The energy behind this move isn't hype, it's structural. Decades of underinvestment, industrial strain, and tight physical availability are converging into what could become one of the most powerful revaluations in modern markets. If this pattern continues, silver won't just be catching up to gold. It might start rewriting its own identity as a monetary asset, not a byproduct of other metals. So the real question now is whether silver's breakout marks the beginning of a long overdue correction in value or the start of a new era where the market finally prices the metal for what it truly represents: trust, tangibility, and time. So stay tuned. If you're into real data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.